Hey guys, JC with Big Game Real Estate. Today we're going to talk about investment strategy and how to select your investment strategy, because one of the biggest things, one of the biggest problems with new guys in the business and anyone really is not knowing what type of investor you are, meaning what asset class am I investing in and what type of investment strategy do I have. Most of the time, you're going to see that folks like to stick with one investment strategy. When you're new, you try to look at office, you try to look at land, you try to look at retail, industrial, and you waste a lot of time. It's a good idea to either pick an investment strategy or pick an asset class or both. So let's get into it. First, it doesn't really matter which asset class, whether it's retail, industrial, multifamily you pick. That's totally your objective. I would look at what's trading in the market, what's hot where you are right now. As far as an investment strategy and what type of deals to look at, let's review a few and let's talk about who you probably are. Number one, it's a term you hear very often: cap rate. Cap rate investor. I'm looking for a 7% cap. I'm looking for an 8% cap, 5% cap. But what does that mean? And who is that for? So a cap rate is the rate of return that you're getting on your money. Again, this doesn't include the debt. But to be a cap rate investor, you probably have other assets, right? Cap rate deals are usually stable assets, whether it's freestanding or multi-tenant opportunities. Someone else has gone in there, they've done the work, they've brought the property up to probably the best it can be or close to it, and now they're looking to sell it for a rate of return. But what's a quick way to analyze that deal? Well, if the cap rate is 6% and mortgage rates are at 6% and you need financing, can't make any money. If the cap rate is 7% and mortgage rates are 6%, you're probably not making enough money if you're just getting started in the business, because you're going to have to put a 20 to 30% down payment, 25 to 30% down payment, and you're only going to get, let's call it, back of the napkin, a percentage of return on your money. That's not going to get you into more deals. If you have a big net worth already and you're getting into the real estate business and you have a lot of cash, that could be something for you. But I'm speaking to the guys who are getting into the business, trying to make some big money, some big flips, some big cash out refis. That's probably not the best strategy. 1031, we hear this term thrown out a lot. But again, remember, 1031 assumes that you have sold a building, right? You need to do a 1031 exchange. This is where you're deferring taxes and you're not paying taxes, but you need to sell a property in order to do that. So if you're new into the business, that's probably not you because you don't have any property. Value add and development. Now, value add is where you can make some really big money in a short period of time. Development, you can make some really big money, but it's a much longer period of time. Again, you have to decide based on the cash that you have currently which one is best for you, but let's talk about it. So value add, what is value add? And how do I get a lead or a property that's a value add opportunity? Well, value add means that there's some work that needs to be done, and this can come in many forms. Obviously, we have a building that is obviously in bad shape, right? So something, maybe it hasn't had a tenant in there for a while. It's been vacant for a bit. We know there's some work that needs to be done. That's a value add opportunity. Maybe there's some deferred maintenance. That's a key site into identifying a value add opportunity. Is, hey, if I'm driving down the road, I see maybe a parking lot hasn't been maintained. I see something's vacant, or I see a tenant that, looks like they're hanging on. They're closed at 2:00 in the afternoon, and it's an opportunity for a larger tenant to come in and lease. Awesome. That's what I'm looking for, right? That's on the retail side. Could be quasi-industrial too. Those are some of the signs you're looking for. If it's a multifamily property, again, you're going to look for signs of deferred maintenance. Landscaping no good, holes in the parking lot, again, building falling apart. Assuming you've already found your property, some of the things you could look for: what is the going lease rate, right? What's the going lease rate? What are the leases for? So if the leases that exist are under market, right, and we know that there's an opportunity to raise them to market value, that could be a potential value add opportunity. Again, we would have to already be in conversations with a seller to figure that out, or a potential seller. And why would someone have under market rents? Well, it could be a long-term lease situation. that maybe the person made with someone 30, 40 years ago. It could be a rent stabilized situation, right? If it's multifamily. So we have to know that to know if we can, in fact, raise the rents and what we can raise them to. We also need to look at lease expirations and lease terms. You know, if we have a 10 unit industrial or office or retail building and the leases are going to expire in a year or two, well, we don't want to purchase that for the premium, right? Because if there's no options to renew or no indication that they're going to renew, we may be able to purchase this property at a much lower value and take on the risk, right? And we want to make sure, hopefully, those tenants are not major tenants, and maybe there's an option to put a major tenant in there. So again, we want to know that. Vacancy in multifamily. If you have a 10-unit multifamily building and it only has 5 tenants and maybe they're on month-to-month leases, that is potentially a good value add opportunity, right? We can go in there, we can tenant the building up, we can get it stabilized to 85% or above. We can probably raise the rents, and now we can have year or 2-year tenants rather than month to month. Okay, so that's most likely the deals that you're going to look at. Development deals could be repositioning and repurposing a property. That is when you look at a site, maybe it has a like I said, a pizza place on it, but it's at a corner at a light, and it could be a good QSR building. We're going to go into cash out refis in another video, but essentially, guys, when you have a value add opportunity, you can go to the bank, you can cash out refi for probably 75% of the value, and as long as your property is still cash flowing, you're in good shape, and you put all that money in your property debt tax free. It is a debt. So, for example, you buy a property, $500,000, you repurpose, you re-tenant, you do your value added improvements, and let's say the second you sign that new lease, it's with a huge company. That building is now worth whatever, $2 million. Well, now you can cash out refi probably up to 75%. That's $1.5 million. So now you have recuperated your initial investment. You've put all that extra money in your pocket, tax free, right? Because it's a debt, you have to pay on it. But now you have money for another building, right? You can go out there and get right back out there. We'll get a little bit more in depth on how that process works. But guys, know your investment strategy. Be able to communicate your investment strategy with other investors, with potential partners, and obviously pick an asset class. Do the research. What's trading in your area? Is it office? Is it retail? Is it multifamily? Is it industrial? We'll catch you on the next one, guys. See you next week.